Welcome all to the fourth season of the Value Investing with Legends, a podcast that explores in depth the tools and methods great investors use to select stocks and manage risk in a complex and changing world. My name is Tano Santos, and I'm the Faculty Director of the Helbrun Center for Graham and Dodd Investing at Columbia Business School and the David and Elsie Dodd Professor of Finance. Since our first podcast in the spring of 2019, a conversation with Mario Gabelli, we have built a wonderful audience around the world and now have a terrific collection of interviews with remarkable investors. But the time has come to change the format of the podcast a bit. I have loved the opportunity to host these interviews myself, but from the very beginning, I have felt that the audience first and foremost, and the interviewees would benefit from having another voice. I wanted a co-host who would challenge the guests and me by bringing a different point of view to the podcast. And I couldn't think of a better person to join me as co-host than Michael Mabuse. Michael is a colleague, a friend, and someone I admire enormously for his passion and ability to merge academic research and the practical considerations of investing, and I'm sure will bring that unique perspective to the podcast. Listeners of the podcast know Michael well, as he has been a guest twice. But for those of you who are joining us for the first time, or may have missed those episodes, Michael is the head of Consilient Research at Counterpoint Global inside Morgan Stanley Investment Management. As I said when I interviewed him last, the word consilient was invented for Michael, for I know a few people whose knowledge is as broad and who can bring together so many academic fields always coherently and intelligently. He was also managing director and head of global financial strategies at Credit Suisse. Before rejoining Credit Suisse, he was chief investment strategist at Legg Mason Capital Management from 2004 to 2012. Michael joined actually for the first time Credit Suisse in 1992 as a packaged food industry analyst and was named chief US investment strategist in 1999. So he brings an enormous amount of experience and industry perspective to this podcast. Michael is, of course, an acclaimed author. His books include The Success Equation, Untangling Skill and Luck in Business, Sports, and Investing, and my own personal favorite, Expectations Investing, Reading Stock Prices for Better Returns with Alfred Rappaport. Incidentally, the second edition of this book is coming out now in the Helbrun Center for Graham and Dodd Investing series. Michael has been an adjunct professor of finance at Columbia Business School since 1993 and is on the faculty of the Helbrun Center for Graham and Dodd Investing, where his leadership is key in the success of the program and the school at large. Michael, welcome to co-hosting duties at the Value Investing with Legends podcast.
Tano, thank you very much for the kind words, and it's a pleasure to join you on this journey. I've long admired your work, and I've always enjoyed our discussions, and I'm really excited by the opportunity to join forces to tap the minds of some great investors.
Yes, and we're delighted to have you here. And with that, welcome to our first episode of the new season of the Value Investing with Legends podcast, now with Michael.
We launched this season with one of the great names in value investing, Ruane, Cunniff, and Goldfarb. Those of you who read Warren Buffett's famous essay, The Super Investors of Graham and Doddsville, which was published in the Columbia Business School magazine in 1984, are familiar with Bill Ruane, one of the super investors that Buffett highlighted, as well as the legendary Sequoia Fund. The history of the Sequoia Fund is well known in the history of value investing. Bill Ruane first met Warren Buffett at a value investing seminar taught by Ben Graham at Columbia University in 1950. When Buffett closed his investment partnership in 1969, he advised his clients to invest with Ruane in the Sequoia Fund. In 1970, Bill Ruane and Rick Cunniff founded the Sequoia Fund to take on Buffett's former investors. Bob Goldfarb joined the firm in 1971. By the mid-1970s, Ruane Cunniff was well on its way to building an incredible reputation. In the best of the value investing tradition, the fund discovered and profited from unnoticed public companies, including the Washington Post, Interpublic Group, and Ogilvy and Mather. In the 1980s, the firm had holdings in Kraft, Sara Lee, and Capital Cities. The 1990s produced stakes in Fifth Third Bank, Progressive Insurance, Harley Davidson, and Johnson & Johnson. All were sold at a healthy profit. Bill Ruane ran Sequoia almost until his death in 2005. There is no higher praise in the investment community than that coming from Warren Buffett himself, who said Ruane, in quotes, did a fantastic job. And even now, if you take the record from the inception, I don't know of a mutual fund in the United States with a better record. The great tradition of value investing at Ruane Cunniff continues today and is well beyond the Sequoia Fund. We are delighted to welcome Chase Sheridan and Will Pan to talk to us about that continuation of the great tradition. Chase and Will joined Ruane in 2006 and 2010, respectively, as analysts and launched the Hyperion Fund in 2019. We are curious and excited to hear about this new chapter in Wayne Kniff's history. Chase is a 2006 graduate of Columbia Business School and joined the firm right out of school. Will graduated from Harvard College in 2010 and went directly to Wayne, where he has been ever since. Chase, Will, welcome to the Value Investing with Legends podcast, and thank you so much for being here.
Thank you for having us. It's always a pleasure to see you both.
So we want to start, as we always do in the podcast, getting to know our guests a little bit better and their career to their current position. So why don't we start with you, Chase? We are curious about your career at Wayne. And like Will, you worked before going to business school and starting at Wayne Kniff. So what was your career path and what took you to the firm?
Yeah, happy to talk about it. My career path to Ruane was highly unusual. So my career in money management actually started on the floor of the CBOE, the Chicago Board Options Exchange. I grew up in the suburbs of Chicago. And if you are, I think, interested in money management and impatient to get your hands dirty, and this was back in the mid-1990s, the floor was a great place to go. It was a great place to get responsibility at a very young age. The flip side of that was that it was really a sink or swim environment. So I remember in my hiring interview, my boss telling me, well, we're going to hire you as a clerk on the floor of the exchange for a year. And at the end of that year, there's a 50% chance that I'll fire you. If I don't fire you, I'll make you a trader. The catch is at the end of your first year of trading, there's another 50% chance I'll fire you. And so that was the environment I went into. And I started out as a market maker in S&P 500 options. And then I moved into a very esoteric niche known as volatility arbitrage or dispersion trading, which in the 1990s was a fairly new concept and really isn't worth getting into. But the long and the short of it was that I had a career as an options trader at a firm called Cooper Neff that was a great place to work. I really enjoyed what I was doing. At the end of every year, I'd get a bonus and I wouldn't know how to invest it. I didn't know the first thing about real investing. And we had a family friend who happened to be one of the very earliest investors, or clients rather, of Ruane, Kniff and Goldfarb, dating all the way back to 1971. And I was on a ski trip in Montana with this friend who was waxing eloquently about the brilliance of his money manager, Bob Goldfarb at Ruane Kniff, and I asked for an introduction. So I became a client first of Ruane Kniff, and every year I would send them my bonus, and in short order, they managed all the money I had in the world. And I, through that connection, became interested in value investing. Started flying out to Omaha with my father to see Warren Buffett at the annual Berkshire Hathaway meeting. And I got sucked in, as many of us do, by the beauty of the philosophy of Warren Buffett. And so I decided mid-career to really upend my life to try to redirect it into value investing. And I went back to school, not really to get an MBA, but specifically to go to the value investing program at Columbia. So that was my target. And if I wasn't admitted to Columbia, I don't know that I would have gone back to school. And very fortunately, it was 2 of the best years of my life, without question. The value investing program was phenomenal. I took Mike's class, security analysis, which I enjoyed greatly, and I still employ some of the lessons I learned in that class to this day. I didn't know that I would ever get a job at Ruane Kniff specifically, but that was the firm that drew me into value investing. And by just good fortune, they happened to have a slot for me, and they hired me halfway through the program. And I went directly to Ruane Kniff after graduating. Like a lot of analysts, young analysts at Ruane Kniff, I didn't ask about salary. I didn't ask about anything other than I just wanted to work with these amazing investors whom I admired. And they put me to work, and I've been there ever since. So that was my odd career path to Ruane Kniff and Goldfarb.
And what about you, Will? What did you study in school? And was a career in asset management always the objective for you?
I was interested in stocks from a young age. My dad was active in stocks in the 90s, maybe a little too active. He involved me in investing, and that's when I read about Buffett. And in college, I studied economics. I took the accounting class at MIT because Harvard doesn't offer that. And then I did neuroscience too. At that point, behavioral economics was really coming to the fore. And I was fascinated by that idea that people aren't always rational. and people make mistakes. And I think that's something that I still think about when it comes to investing. I was a research assistant for a guy named David Lapson over there who's done some great work in behavioral economics. So I did some investing in college. I was part of some clubs, some student funds, wrote some investment pitches, but I also dabbled in other things with startups and tech. And all I really knew that was that I wanted to be in business because companies really fascinated me. And I think everything sort of came to a head in the summer of 2009 when I was choosing where to go for my junior year internship. So I had a couple paths in front of me. I could go do consulting. I had an offer to be a program manager for a big tech company. And then I could intern at Rowan Kniff. And I'd say that it's not always in life that we realize how lucky we are at any given moment. But I think I was fortunate to realize at that point that interning at Rowan Kniff would be a once in a lifetime kind of opportunity. So I had my heart set on that. I knew I would learn a lot about business and it would be applicable, whatever I ended up choosing to do. It was kind of funny because the recruiter at the big tech company, he kept calling me and offering more money because he thought he was up against this big Wall Street company. But at the time, Rowan Kniff hadn't really updated its pay policy. So we got paid $1,000 a week as a stipend. So he was already the highest offer. But I wanted to give it a shot, even though I knew that Rowan Kniff didn't hire every year and it wasn't necessarily likely that I would be able to stay. But I did the internship. I loved every minute of it. I loved the work. I loved the people. And so I was really thrilled to get invited back, and I've been here ever since.
There are many points of connection here because obviously Michael and I are deep into the literature on behavioral economics. And I still remember very well when David Lapson's work on hyperbolic discounting came into academia, what a big shock it was and what a big impact it had on academia. And as for your career, Chase, it mirrors mine inside academia. I started teaching at the University of Chicago the options and futures, derivatives, fixed income, derivative securities. And it was in 2000, I believe 2009, 2010, that I started reading Ben Graham when I started working with Bruce Greenwald here at the business school. And of course, the same experience as you did have. But once you read it, it's difficult to go back. So the bulk of our conversation is going to be devoted to what you guys are doing at Hyperion Fund. We're very curious, obviously, about the new name in town, so to speak. But we were reading your inaugural letter that you so kindly sent us. And you emphasized kind of the very strong connection, of course, that you have with Rowan Kniff and Goldfarb. So can you explain what is that tradition? How do you build in that wonderful tradition of Rowan? And why is it relevant still today? And what is that you are doing with that tradition inside Hyperion?
I'd say the essence of how we invest at Rowan Kniff and how we've always invested is that we view stocks as ownership in businesses. And it's kind of trite, and a lot of people say that, but we really, really, really believe it. And when we own a stock in the portfolio, it's not a line that's wiggling on the screen. It's not a piece of paper that you trade. It is partnership, ownership in a business. And we just strive to understand that business as well as we can, understand the people who are running it as well as we can, and evaluate the stock relative to that, whether we are getting fair value in the business that we own based on where the stock is trading.
Chase, anything you would add to that?
I would add just that when you are investing in that manner, there are no shortcuts. At Rowan Kniff, there isn't some sort of targeted research budget or some limited time frame during which you're allowed to analyze a business. You work on the business until you understand it, and you go as deep as necessary. And I think that's something of a rarity even today on Wall Street. We really don't shortcut the research process, and the purpose and the benefit of doing deep research like we do is to discover and unpack economic drivers that may not be obvious at first glance, or that may be less commonly appreciated by our competition. And so I think it's always been our calling card. I think that is a timeless attribute that will continue to be an important part of our investing for as long as Rowan Kniff exists.
I do want to follow up on that a bit. I mean, when people think of value investing, they often think about the idea of buying things that are statistically cheap. So low price to earnings, low price to book. There's also another sense of value investing at buying something for less than what it's worth and buying a partial stake in a business for less than what it's worth. Sounds like you're doing much more the latter than the former. But do people ever come back to you and say, are you not really doing value investing because you're not buying cheap things? Or how do you reconcile those two concepts?
We focus maniacally on the intrinsic earnings power of a business. And that may be a business that looks statistically cheap, such as credit acceptance, which trades for a single-digit multiple of earnings currently in our portfolio. Or it may be a business that looks very expensive on the surface, such as when we bought Amazon for 150 times GAAP earnings, but for what we thought was a very reasonable multiple of our estimate of intrinsic earnings power. So it always boils down to intrinsic earnings power, and that may or may not align with the metrics that allow a company to screen cheaply. We have some companies in our portfolio that just screen terribly. And the reason is that they're usually investing heavily in growth initiatives that should help them compound value in the future at a very good rate. And it penalizes near-term margins. And when we find something like that, we tend to be attracted to it because if it screens poorly, it may attract less intelligent competition from other investors, that is.
Before we get into the weeds of how you methodological issues and how you guys approach valuation, stock selection, and so on and so forth, can you describe briefly for us the current structure of Ruane? Do you guys have a common research platform across all the different vehicles that you have? Can you tell us a little bit about that and clarify the relation of Hyperion with Ruane?
I think people often think of RCG as only the manager of the Sequoia Mutual Fund, but we've long served as the home for additional funds. And we've got a big pool across all the funds of research talent that is just churning out all kinds of great analysis all day long. They all stem from the same investment philosophy that we've been talking about, and they draw from the same pool of research, but they just represent different twists or flavors. And Hyperion would be another addition to that family. And maybe the name will give you a sense for it. Hyperion is actually the name of the tallest sequoia tree that's been found. So it's not that we've started naming things after Greek mythology. We're still on Greek.
I was very baffled by that, I have to say. So thank you for the clarification on that.
I think Hyperion is reflective of, it's a different flavor of the same dessert, which is that it serves a slightly different client base than our flagship Sequoia fund. Sequoia is somewhat unusual in that it has a lot of individuals as clients and a lot of individuals who have their entire net worths wrapped up in the fund or in separately managed accounts that mimic the fund. And we're very aware of that when we're investing on their behalf. Hyperion has a more institutional client base, and as a result, it has a slightly different approach to portfolio management.
So analysts and students are a really important part of our audience. And one of the questions we constantly get in the classroom is sort of this aspect of career management that takes you from an analyst to a portfolio manager. So can you guys just share a little bit about your career path within the firm? How does the process from being an analyst to portfolio manager work? And more importantly, perhaps, what skills are the same for analysts and PMs, and which skills do you have to learn or acquire to be successful as portfolio managers?
Michael, I'm probably the only person you'll interview who started his career as an analyst with 8 years of portfolio management under his belt. So if you have any listeners who are looking to move from portfolio management to an analyst role, I'm your guy. But going the other way, Will may be the best person to speak about it. I had a bit of an unusual background. Will, do you want to talk about the process within Ruane?
RCG is an interesting place. It starts with Bill Ruane. He used to say that his business card would say Bill Ruane, research analyst, not portfolio manager, not founder, not CIO. And we maintain that ethos all the way through today. We all consider ourselves analysts first and foremost. Even if you do end up being responsible for a portfolio and make decisions for a portfolio, you still do analysis work. You do your own research projects. You partner with people on research projects just the same way you would as an analyst. That really is the utility player at our firm. We kind of think that the portfolio management actually is relatively simple if you do a good job on the research and the analysis. You do have to think about concentration and common risk factors and that sort of thing, but that doesn't consume a lot of our time or brain power relative just to the analysis of businesses and making sure that we get each individual investment right.
So let's start talking a little bit about Hyperion, if you guys don't mind. And I want to ask a bit of a delicate question. I want you to go back to what you were saying just a moment ago, Chase, which is obviously beyond the personal ambition of a career path in which you want to end up managing funds. Is it just client selection, the difference between Hyperion and Sequoia? What is that you guys do differently? What is that you think, well, this particular client base is going to allow me to do X, Y, and Z, and that's a little bit more difficult to do at Sequoia? Is it communication with institutional clients? Is the long-run outlook? Is you burdened perhaps by the reputation of the Sequoia fund? What is it that launching on your own is going to allow you to do that otherwise you wouldn't be able to do?
Hyperion was really launched at the impetus of certain institutional clients who requested that we provide a vehicle that was A, even more concentrated than Sequoia, and B, fully invested at all times. And the first client in Hyperion was someone for whom we'd been managing a more concentrated portfolio for a number of years. We'd made an exception for that client, and it provided us with an inkling that this might be a product that would be well received by our existing institutional client base. So it was really in response to their own desires, and it wasn't so much a vehicle for Will and Chase. In fact, we conceived of Hyperion before we knew or decided who would be managing it. Now, it will obviously reflect the natural inclinations that Will and I have, our preferences. We tend to have very similar preferences for the kind of businesses we like, and I think that's why we wound up paired as portfolio managers on Hyperion.
And it's only you two, Chase, co-managing the portfolio. Just you and Will co-managing the portfolio.
Yes. It's just Will and I are co-managers. It's entirely our discretion.
One question I want to ask is, it's a fascinating observation in the investment management industry is that funds, maybe a generation or two ago, and certainly when Sequoia was launched 50 years ago, were almost always single person managed, one portfolio manager. And increasingly now, I think more than 3/4 of them are team managed. I'd love to just have you guys follow a little bit in that evolution. Obviously, we have a team managing this fund. Have you evolved that? And what are the pros and cons of the team? Because I guess the pros would be you have different points of view and different sets of experiences. The con might be sort of an accountability, who makes the ultimate decision. So how do you guys handle that balance between what's good about working together and what might be more challenging?
It's interesting. We're always trying to strike that balance. We do think that diversity of opinion is important to good decision making. You'll find that sort of throughout the firm now, we're taking much more of a team-based approach. For Chase and I specifically, like Chase was saying, we found ourselves to rhyme in a lot of ways. We like the same sort of stocks. We worked on the same sort of projects. So it's very natural for us. And it's kind of a funny story. When we started the fund, we said, well, we don't want to succumb to groupthink of any sort. We know that we think very similarly. Let's go away into our respective offices. Let's construct the portfolios that we individually would want this to look like. And then we did that. We came back, and the portfolios were remarkably similar. We were both surprised at not only the fact that we selected mostly the same things, but they were sort of weighted in roughly the same rank order as well. So we are constantly trying to make sure that we don't succumb to groupthink and that we do our work independently so that we are bringing diverse perspectives to the table. But it is a very smooth working relationship because we are so often on the same page. And we have never run into a situation where it's one vote for, one vote against, and a stalemate. We've always been able to sort of convince each other when we do disagree, just debate it out and come to a decision.
Now you guys learning about each other's behavioral biases at the same time and learning how to control it. I know Chase likes this, or I know Will likes this. He always.
Oh, of course. And we've known about these for a long time as well. But it certainly is. We do things like we'll go investigate our trade ledger. We'll go through the decision and talk through them with each other to decide whether this was a good decision, good outcome, good decision, bad outcome, bad decision, good outcome, bad outcome. And we are constantly learning that sort of stuff about us individually and then how we function as a team and trying to incorporate that into the feedback loops.
I would just make a note, which is that while Sequoia is, of course, associated with Bill Ruane, the management of Sequoia was very much a team effort going all the way back to the beginning. And Bill and Bob and Rick really operated as a triumvirate. And it was not just a one-man show. I think Bill was obviously the spiritual leader, but it was a team effort even back then. And so, as you know, Sequoia is now committee managed. It's managed by a team of 4 people. We liked the dynamic there, and we wanted to bring that to Hyperion. We didn't want a sole manager at Hyperion. We wanted it to be at least 2 people, and 2 seems to be working well at the moment. Mike, I think you would probably say that the data suggests 3 is usually the optimal number, but so far we haven't run into any. It seems to be working for us.
Will, can I go back to something that you said just a minute ago that I found quite interesting? I have a lecture on this to my students. You mentioned a trade ledger and how important it is to actually to keep track of your decision process. What was the thesis into which you used to go into a particular investment? Can you elaborate a little bit on that? I mean, I always thought this was a wonderful institution, sort of trade ledger, sort of a diary of. Can you tell us a little bit more about that and how you guys utilize it in order to improve your decision making?
So we do this on a sort of regular basis. We'll download our trade ledger and we'll tick through it, and we'll try to figure out, based on subsequent performance of the stocks that we bought and sold, whether it was a good decision or not. We can do a better job, honestly, of documenting the decision making at the time of, although we can always look back and see what sort of decision we made. We also have a practice at the firm. We write a lot. And one of the things that we write that actually Chase instituted was we write thesis memos. So on a regular basis, we update the thesis on a stock. And maybe he was inspired by you, Mike, because it's sort of the thesis, and then it's also kind of a pre-mortem. What could go wrong? What could go right? What could go wrong? And then we try to keep these updated and therefore have a record of what we were thinking at any given time, because it's so easy to just sort of manufacture what was going on in our heads after the fact.
I actually think that is quite important. I think there's a wonderful tradition in value investing of good writers. And I think it's because writing forces you to slow down and think exactly about the thesis and how tight it is. I don't know if you agree with that.
I absolutely agree. And the other question I just love to follow up on is, have you found any patterns that are interesting that you buy too soon, buy too late, sell too soon, sell too late, sizing issues? I mean, are there things that you've been able to glean from your actual behaviors that allow you to get better going forward?
I'll speak a little bit to this. Just to emphasize Will's point about Ruane Cunniff being a writing culture, we document our research from the first call to the last, so that we have an internal research system with memos coming all the time from our analysts. I remember a third party recently called us trying to sell us their wares, saying, we have over 10,000 transcripts from different calls, and you should subscribe to our service because look at the body of work that you'll have access to. And I said, you're not even close to what we have internally. Call me when you're bigger than we are in terms of your internal database. So we have documented research on thousands of companies here. And all of that research has a date and a stock price associated with it. And so we can go back and see, and not just on trading decisions, but in every single step of the research process, where we were, what we were thinking. It's all in writing. It's an invaluable resource. And I think that for that introspection and retrospection that we regularly do is what has guided Will and I towards the kind of companies we like today. So if you ask me personally how I've fared with, say, turnarounds over the course of my 15-year career, I would tell you that I'm out of coin flip. Half the time I beat the market and half the time the market beats me, and it's not a very good pond for me to be fishing in. So you need to recognize that and be self-aware. And one of the things that's led Hyperion into the kind of companies that invest in is that we found that we've done really well with those kinds of companies, and we can get into that. But all that comes from focusing on what's worked for you and being a bit of an empiricist about your results and trying to not fool yourself.
That's a great segue to the question of I know you guys already described that you're business analysts. You like to think about the long-term earnings powers of businesses. But what is an ideal Hyperion investment? So what are you guys looking for in a firm, and what are you looking for in a stock? What is the dream for you and what you're after?
And the issue of idea sourcing, where does this initial pool of ideas come from? So if you can tell us a little bit about that.
I'll start with the ideal investment, Hyperion investment. I can use some of our current holdings to illustrate. The ideal investment would be something with super fast organic growth and runway ahead of it, something like Facebook, with the M&A prowess and discipline of a Constellation Software, recession resilience like United Health. We'd want it to be run by a founder, major owner, and operator like Gilles Martin of Eurofins. And we want it to trade for a low valuation like Credit Acceptance, which has taken advantage of its consistently low valuation by repurchasing 40% of shares outstanding over the last 10 years. So it's sort of a chimera of all those things, and all those things are represented in our portfolio, but balanced by other things. But if we ever found something with all those attributes, we would be running, not walking.
You can see why I love having Will as a partner, because he just managed to plug half our portfolio in his answer to your question.
We noticed that actually. That's very skillful, Will.
But they do have certain characteristics. We like companies with readily identifiable advantages, firms that are the best at what they do or unique in what they do. We like firms that have demonstrated differentiated product for their customers, which is usually indicated by market share gains. And we like to say we like market share gainers, but we also prefer that they be gaining faster than anyone else in their industry. We like smart and aligned managers, and that usually means significant owners in the businesses. So we do have a bias in favor of founder owners typically. And like many others, we like conservative balance sheets. We like businesses that are resilient and are financed to withstand a storm.
Do you have any type of a structure, quantitative filter to give you that pool of companies that at least meet certain criteria, which is an ideal Hyperion investment?
Well, we all keep different lists. Chase is sort of the keeper of the list of companies that are run by founder owner managers, and he tracks that very closely. And everybody knows that if they're looking for a new project like that, they can go to him and see what's next on the list if we haven't covered something already. And then I keep a spreadsheet of fast-growing SaaS companies for one, and I have it organized by the growth rate and then the valuation, usually price to sales, and then some other different metrics. And we all keep different lists, and each of the analysts is usually sort of looking in specific areas. We've got 25 full-time analysts who are deep in this kind of work, and we talk about this as sort of what we look for in Hyperion, but it's common across the entire firm. Everybody at Ruane Cunniff loves these attributes about companies, and we're always looking for the right combination of all of them to research next.
It's probably not a very satisfying answer when someone asks us, where do you get your ideas? And we answer, we get them from everywhere. But we're really blessed. We have 25 fanatics combing the markets every day for opportunities for us to invest in. And you can really cover the waterfront with that level of resources. So we really do get them from everywhere. And while we have our personal biases and inclinations for what we like, we think it is important to play more than one note. The firm philosophy is to play more than one note and invest in more than one type of company. Opportunity can come from a variety of different places. And so we are willing to look at a lot of very different sorts of companies, and we don't want to just focus on one specific niche.
When you guys are thinking about how you sort businesses, a couple of empirical observations that we can make is one is investors, by and large, overestimate growth for businesses. So while we're all looking for growth businesses, the challenge is that often they don't grow as much as people think or what's priced in. Second, is we also know that M&A is really a hard way to create value. At least empirically, most deals don't add value. Those are your number one or two criteria. So how do you sort those companies you believe will achieve the growth or do better than what the market anticipates? And how do you find those executives, those founder executives who really are the great capital allocators that know how to do deals that add value versus ones that are neutral or even value destroying?
Like Chase was saying earlier, there are no shortcuts. So it is just turning over every rock. We place a lot of emphasis on scuttlebutt, getting a 360 view of a company by talking to competitors, suppliers, customers, ex-employees to really understand the nature of the beast and its market position, what its likely future trajectory is. And of course, we don't always get it right, especially in the cases where there's fast growth, but we have been at it for a long time, and we are constantly trying to hone our ability to predict that. The same with capital allocation. We sort of investigate what the track record has been. We go through that same diligence, talking to people who have been involved in the deals as sellers or as brokers, as customers, as employees who have been through the integration process. And we try to understand if the rationale for the deal made sense, whether the executives are really thinking about it the right way, because you can have a good track record sort of incidentally without actually thinking about returns and thinking about risks the way that we would want them to think about it. So we just spend a lot of time crossing our T's and dotting our I's to make sure that we have a feel for it.
I think there is some persistent patterns among the subset of mergers and acquisitions that do create value. And you can look at Berkshire Hathaway 20 years after Warren Buffett became famous, and you would probably be able to predict that his next acquisition was more likely to be value creating than value destroying, given that you're talking about Warren Buffett. And you can look at the market, and these exceptional managers exist everywhere, and they're readily identifiable, and they raise their hands. And we don't own all of them. So whether you're talking about Mark Leonard at Constellation Software or Gilles Martin at Eurofin Scientific, those are businesses where you don't have to catch the first double or the second double or the third double. You don't have to catch the business in its first 10 acquisitions or its first dozen. You can wait, and you can see a demonstrated track record over sometimes decades before committing capital. And there are players out there who are doing this on a regular basis. Bill Stone at SS&C, Alain Bouchard at Alimentation Couche-Tard, Serge Godin at CGI, among others. And so we keep an eye on these people and these businesses, and they don't always trade for valuations that are attractive enough for us to invest. But they are interesting places to look because value is being created by these managers on a consistent basis. In a lot of cases, the acquisitions are small enough that one bad acquisition won't kill the investment.
I mean, to put a finer point on it, we're trying to evaluate the process. We're really trying to get at exactly how management is thinking about it, how they source it, how they go about integrating it. Same way that we think of them as sort of outsourced managers of our capital. And we want to understand their investment philosophy and their approach.
And
we'll talk about a couple of names in more detail in just a moment. But before we get to there, I'd love to just talk briefly about how you guys do think about valuations, or what are the core principles there. And in particular, an emphasis on how you value intangibles. This is obviously a very hot topic now in both the academic and the practitioner community, clearly very relevant for the types of businesses that you're looking at. So how do you guys value business in general? And then how do you take into consideration intangible investments, which, by the way, are often expense, which are deleterious to earnings, but may actually create a lot of value in the long run?
We're focused on intrinsic earnings power. We're trying to understand what is normalized earnings power in order to understand what we're paying at any given moment. And then we do a lot of work to try to understand what the trajectory of the earnings are over time, because at the end of the day, that's the old saw, right? It's the value of the firm is the discounted cash flows. And that's what you can eat at the end of the day. It may not be the tangible or the intangible assets, it's what they throw off. And so we spend a lot of time trying to understand the nature of the franchise, whether it's tangible or intangible. And we think of just the way that people would think about investments that were capitalized in the past. We do seek to recognize investments that are expensed through the P&L as well.
There have been a lot of opportunities, I think, over the last decade, investing in businesses that were investing significantly in growing their flywheel without reporting significant GAAP earnings. The most prominent among these was Amazon, as you know, and we were investors in Amazon. And it took us a long time to get comfortable with our estimate of that company's intrinsic earnings power, because it's a complicated beast. And the analyst who covered Amazon for us, he did calls in the triple digits. And by the time that project was finished, I think he knew more about the margins of Amazon than most of the employees who worked there, because it was very siloed in terms of the availability of information internally to the employees of Amazon themselves. And we sort of set on that one, just to take a case study, we worked backwards. We identified losses from growth investments, and we put them aside and say, all right, here's what we've been able to identify. Here's how many billions of dollars they're spending on it. And that was one approach to triangulating their true earnings power. So when we purchased Amazon, we thought we were paying 30 times their true earnings power at the time. And of course, it was growing like a weed. So it was a very, very compelling investment for us. It took a lot of work. So as Will said, there's just no shortcuts.
Before we move to those couple of names, there's another question that I want to ask about these founding tools of any good asset management practice. And it's one of the most mysterious in asset management, and one that we get asked often in the classroom, for which we have little intense answers, which is this issue: how you size your positions, how you incorporate diversification motives into your portfolio construction, issues of industry concentration, trading off the issues of specialization and diversification, of course, is an important issue as well. So why don't you tell us a little bit about your process inside Hyperion to portfolio construction?
It's very much an art rather than a science for us, and intentionally so. And within Hyperion, we maintain awareness, obviously, of common factors across our investments. And we want to make sure that any risks that we're taking on in that respect are intentional. We have a dozen different investments in 11 different industries. The two investments that really have a common driving factor are Google and Facebook, which are both driven by online advertising and subject to some of the same risks, including the scrutiny they're getting by federal authorities for monopoly power. So while we are aware of the common drivers among the portfolio investments, we are not pseudoscientific about it. It's using common sense and intuition. And when it comes to sizing, we do size those positions where we have higher conviction bigger than investments where we might think the returns are just as good or higher, but the variability in the potential outcome is higher as well. We look at risk-adjusted return and our conviction and our ability to understand the business when considering sizing. Will, what would you add to that?
Yeah, when it comes to sizing, Jason and I, we maintain our view on prospective IRRs for the various stocks that we're considering for the portfolio. And you could just rank those and then size the portfolio accordingly. But obviously, that would be a naive way to do it because there are risks embedded in all these. And there's certain managers we trust to surprise us on the upside more than others, or steward our capital better more than others. And that's not always built into the prospective IRR as much as we would like to incorporate it. And as such, we have overlays, or personally, I do just different rankings for how much I trust the management team to allocate the capital well, and then how resilient the business is, and various other qualitative factors that we think are just as important as the quantitative. What's the prospective growth and how does that translate into return? Just not as easily quantifiable.
And just relating to understanding the path of the earnings power of the business, and also even for portfolio construction, do you guys run scenarios? Do you say this business is here today? If it goes well, it could be X. If it goes poorly, it goes to Y, what have you? Thinking about scenarios and where you might be in that set of scenarios.
The analyst will usually run a few different scenarios. I don't know if it's as formal as the way you phrased it implies. It's not a formalized process for us, but very commonly an analyst will say, here's my expected return on the investment. Here's what could happen in the best case, the blue sky scenario. Here's what could happen if I'm wrong, and here's where I'm likely to be wrong. We do it heuristically, Mike, I would say, rather than formally. But
I've been in some of these pre-mortem exercises, and they're quite interesting in a way. You learn a lot thinking through some wild scenarios, and there's someone always in the room who, oh, that happened here and there in that industry, in that country. And all of a sudden, you reweight your probabilities of particular scenarios, unlikely as they may be.
Yeah, it's amazing how often tail risks will come back to bite you. Scenarios that you consider unlikely turn out to be less unlikely than you think.
Yeah, absolutely.
The topic of portfolio construction, I do think there is something that is worth saying for students or people who are new to the business. It's an issue that I've observed with young portfolio managers in the past, which is a lot of folks getting into this business want to emulate their idols. They want to emulate Warren Buffett, or they want to emulate Joel Greenblatt. And the issue with concentration is that the right answer for one person is not the right answer for another person. It really depends on what your edge is, and the appropriate level of diversification is different for different people, and it's even different for different firms across time. So if you look at Sequoia Fund, in the 80s, we often ran with a single digit number of stocks in the portfolio. It was a different level of competition back then, number one. And number two, we didn't have the research resources that we have today. And so today, Sequoia runs with about 25 stocks in the portfolio, and that feels appropriate for the time. What I don't like to see is young first-year portfolio managers emulating Warren Buffett by being hyper-concentrated in their portfolios, or emulating Joel Greenblatt by owning 5 stocks when they don't have the same level of advantage that Buffett did when he was investing in American Express after the salad oil scandal, or Joel Greenblatt was investing in spinoffs in the 80s. It really is an individual answer for each different manager, and it depends on what advantage you bring to the table.
That's actually a wonderful comment, and that relation between your research facility and your research power and what you can afford in terms of diversification is absolutely key, and a point that is typically missed. Can I suggest that we move then to a couple of the names you guys have mentioned and whether we can project some of the ideas into those names? So one that Will brought up is Constellation Software, kind of a roll-up. Can you describe first for our listeners what a roll-up is and the challenges that come with investing in such a company? And we take it from there, and I ask all sorts of dumb questions about roll-ups.
So a roll-up is a common term of art for a company that makes a lot of acquisitions in a particular field and is rolling up all of the businesses in that particular industry and consolidating it. In the case of Constellation Software, it was founded in 1995 by Mark Leonard in Canada to invest in vertical market software companies to roll up that industry, if you want to call it that. He'd prefer to call it a conglomerate. He's built just a tremendous track record doing this, but not all roll-ups end up happily. There are many conglomerates or roll-ups from the sort of 60s and 70s that ended in tears. It's always the case that there are roll-ups happening all around us as we speak, and some of them will do well and they'll be disciplined and they will not ever get over their skis. They'll integrate things well. They won't overpay. And then there will be ones that are overpaying, that are not actually adding value when they do M&A. They're growing, but they're destroying value. And so the key is to try to understand the distinction between these. And we think it goes back to just investigating the process. Does the company have a sound process? Do they think about these investments as not purely just growth and accretion, but investing the capital at a high rate of return with a high probability of success? And then the other thing that you have to keep in mind is incentives. A good process, plus making sure that whoever's managing the roll-up is not just trying to run a get-rich-quick scheme or make bad acquisitions with shareholder money, but that they feel that this is really their own money. And that's why we prefer situations where there's a founder, owner, operator in charge, somebody who's seen the business from the beginning, who has a big stake in it and will invest the money, your money, alongside theirs and really consider it their own.
And Will, can you just discuss why the vertical software industry is appropriate for consolidation?
One is that it's extremely fragmented. So think of any business out there, think of any organization out there, really, just to keep things in order administratively, they need some sort of software, and they often need it to be customized. So they don't want to just run it on paper or Excel. So there are all these little software businesses out there that are providing specialized solutions to run things as various and diverse as fitness gyms, golf clubs, municipalities, nonprofit organizations, libraries, and sort of think of any organization or business endeavor out there, and they're probably using some sort of software, and they could be using specialized software. And it differs not only by vertical, but also by geography. So there's going to be a Dutch company that does pharmacy software that processes prescriptions from the GPs to the pharmacies. And so Constellation is out there acquiring these. And one of the wonderful things about this industry is not only the fragmentation, but how sticky these software solutions are. These are often just mission critical for the running of that organization. And there's often nothing that these companies or organizations would like less than to switch and to have to go and retrain their entire staff on a new kind of software. So it means that when you purchase one of these things right, it has staying power, and the decline curves are usually pretty predictable. And you can actually, if you make the right investments, sort of maintain that franchise quite well. And then just the fragmentation means there are a lot of little ones out there. And so Constellation has just built the best machine to go hoover up these little software acquisitions, usually buying from the founder or the family that originated it for a nice price.
Just to go into the weeds a little bit, obviously these sellers are trying to maximize their value as they sell to Constellation software. What exactly is the formula that Constellation applies to create or build value from what the price they pay for these things? Because we know the best roll-ups tend to have a formula. Are there specific elements of what they do to add value once it's in the fold?
They absolutely have a playbook for how they improve businesses after they've acquired them. But before we get into that, I mean, the thing that they would tell you is that the thing that really determines the return, the IRR that they make on any given acquisition is the price. So it all starts with the price that you pay. And they are constantly in touch with, they have tens of thousands of these little companies in their Salesforce database that they're consistently reaching out to see if they're ready to sell. And it's not just ready to sell, but ready to sell for the right price, such that Constellation can make its return. And you'd be surprised, these small businesses don't often have a lot of suitors. In many cases, they do have issues. They are run by sole proprietors who may not have maximized the value of the business, or potentially have undiversified customer bases where an acquirer who doesn't benefit from the law of large numbers would be nervous about buying because maybe there's a large customer that could go away. For Constellation, they have hundreds and hundreds of these businesses, and they're acquiring 100 plus every year, so they can really play the averages. And as a result, they often sole source these deals.
What is interesting about this case, they're an acquisition machine. They acquire a lot of these small companies. I assume they're thinking also about the possible tie-ins between the different businesses, that I can perhaps offer some clients bundles that otherwise they would be not aware of. I wonder to what extent many of the acquisitions also have a flavor of, well, I have this business here, and that other business that I don't own yet can threaten an existing business, and I need to acquire. There's a lot of talk about killer acquisitions lately. By the way, the computation of the yield on a particular acquisition that is associated with that threat of a barrier to entry can be very different. You can pay through the nose precisely because the seller knows that they can threaten your profits and extract the rents from the price. Is there a lot of variation in the type of acquisitions these guys do? How do they integrate them with their existing portfolio of firms? How are they structured in order not to have this curse of dimensionality, so to speak, where they have so many different businesses inside that it's difficult to keep track of what the conglomerate is doing?
So they do make some of these, what you might call defensive acquisitions. They're upfront and transparent about that. And they have their own framework for valuing them. What they've found, which is interesting, is that it goes back to the stickiness of the software. The customers on these software solutions are really, really loath to switch. In many cases, they have way overstayed their welcome. Some of these software solutions have components that may go end of life. And you'd think, oh, that's the company's fault, the software company's fault for not updating it. Well, sometimes it's the customer's fault. Sometimes it's just that the customers really, really, really do not want to switch. It requires effort on their part to upgrade as well. And so often they just want to stick with what they've got. And so what Constellation sometimes finds is that when they own the legacy asset and something's about to go end of life and customers feel compelled to switch and potentially switch away from the Constellation solution, Constellation can go buy a more modern cloud-based rewritten asset, and they'll buy it and they'll offer it as the on-ramp or the upgrade path to those old customers. And the old customers still won't switch. They just are happy knowing that there is an option for them to switch and stay up to date when the time comes. And so sometimes these defensive acquisitions are not necessarily risky in the sense that you have to move the customers over. Sometimes they're just a way to keep the customer. And nowadays, it's been interesting. If you look at the acquisitions Constellation's been making more recently, a lot of them are SaaS companies. A lot of them are modern SaaS operations because there's so much venture capital out there that for every winner and every unicorn that we've heard of, there are all of these other companies that just failed to achieve product market fit, failed to get the sales and marketing rights so that they could take over that market, but they still have a great solution and great bones. And so Constellation is still sometimes able to scoop these up for quite a cheap price to provide that upgrade path to their customers.
So we'll just, for our listeners, for a little bit of a level set, can you tell us briefly the revenues of Constellation Software, the earnings power and the earnings growth you expect from that, where the stock is roughly speaking, what the market cap, just the sort of background facts?
So the revenue of Constellation for this year is going to be $4 billion. The market cap in dollars is about $36 billion. We think that it's sort of a mid-teens grower. And one of the nice things about the company is that you always know the number of shares outstanding because they've not issued any shares. They've not bought back any. So it's 21,191,530. Easy number to keep in mind. And so on our estimate of the future earnings power, we think about the stock price in dollars, about $1,700. They can earn about low 40s. And so it's a little bit over 30 times with, again, a kind of a mid to high teens kind of growth rate.
It's like a fascinating company. I think there's something very much that listeners should be aware of. I mean, these kind of acquisition machines, there's some very successful ones, obviously the ones that we all know about, Teledyne, Berkshire, Danaher, and so on and so forth. And it's worth studying them and why they did succeed. There's typically kind of a discipline to these acquisitions that is worth understanding. And in particular, there's some that have been able to deploy an enormous amount of capital for an extended period of time doing these acquisitions. And I'm totally with you guys that when you find that particular company that has that acquisition platform that you can see has a long runway, that's really a compounding machine that you want to investigate and to understand well and to ride with the, in this case, the founder owner for a long time. And on that score, why don't we switch a little bit to Eurofins, another company that it would be fun for our listeners to understand. I know this company a little as well, but it would be fun to get to know it a little bit better. So Chase, do you want to take that one?
I'd be happy to. And then Will, if we get a chance to return to Constellation, I would love for you to address how Mark Leonard has diversified the decision-making on the acquisitions. Because
do you want to take that one first, Will, and then we go back to Eurofins so we don't lose the thread?
Yeah, it was a question that Mike asked that I forgot, which is, how do you keep track of everything? They've got, at this point, close to 1,000 entities, all doing different sorts of things all over the world. They're making hundreds of acquisitions a year. And Mark Leonard is unique in two ways, and it actually harkens back to something you just talked about, Thanos. He's studied all of these, what he calls high-performance conglomerates. So he has gone back and done case studies of Berkshire Hathaway, Danaher, Ametek, all these companies that have pursued roll-ups, built conglomerates over the years. And he's concluded from this that usually what they end up doing is making bigger and bigger acquisitions. Over time, because of the limited bandwidth and the increasing amount of capital that these companies have to deploy, they just make bigger and bigger deals. And it's harder to make the bigger deals. You face more competition from other strategic players, private equity, et cetera. And one of the things that he's very consciously done is to keep making the small deals, which is pretty unique among high-performance conglomerates in history. I mean, there are parts of Berkshire that are still making small deals. Maybe Marmon is still making deals that are smaller than the sort of big commitments that Buffett is making up at the top. But the amount of capital that Constellation is deploying, $500 million a year on acquisitions, is mostly still being done in sort of $5-10 million deals by this whole team that he's trained to run this process that he pioneered. And so it's not just the 6 operating group managers who are one level below him that have been with him for decades, but it's then the 6 people or 6 or 7 folks or whoever or whatever number report to those 6 folks. And then a level below that, those are the people that are making the deals, and they've been sort of trained and inoculated and invested with this responsibility to go out and make disciplined acquisitions and care for these companies.
Actually fascinating. So Eurofins, Chase, tell us a little bit about it.
Happy to, Tano. So I think a lot of listeners won't be familiar with Eurofins. So let me give you just a basic overview. Eurofins is a testing company. It provides testing services to customers in the food, pharma, environmental, and clinical diagnostics end markets. They offer every kind of test imaginable to ensure the quality, authenticity, purity, chemical makeup of their customers' products. And lately, that last vertical, clinical diagnostics, has taken on special importance because Eurofins has processed more than 25 million COVID tests since the start of the pandemic. It was certainly not a big business for them, obviously, prior to the pandemic, and it's one that we, like many others, are hopeful that the need for COVID testing declines sooner rather than later. So Eurofins is a diversified testing company, and to give you a sense of its scale, they operate 900 labs in 50 countries, and they perform more than 450 million tests each year from a menu of more than 200,000 different tests. Incredibly, this company is only 34 years young and is still run by its founder, Gilles Martin, who is not yet 60 years old. So I guess the first question would be, how do you get a company of this scale in 34 short years when it was founded with 4 employees in a single lab back in 1987? And the answer is he's done a lot of acquisitions. And so I don't want to give listeners the impression that all Hyperion does is invest in roll-ups. It's only a minority of our portfolio. But Eurofins does rhyme with Constellation Software in this respect, in that it has a brilliant capital allocator at the helm. And Gilles Martin has conducted more than 300 acquisitions over the life of the firm. And so what I think is important is if I describe to you the structure of the industry, you will probably come to your own conclusion that this is an industry that makes a lot of sense for consolidation. So the thing about testing is that it's an extremely sticky service. Customers often stay with the same provider for decades, and service levels matter a lot. They matter more than price. Testing is typically a really low-cost service in the context of product value, but it's mission critical. And to give you a sense of the scale, in food testing, food test spending runs at about 0.1% to 0.2% of global food turnover. So mission critical service, not very important in terms of pricing. The other thing about testing that is really important is that it's really scalable. And there are advantages to being large in a given market. So Dr. Martin likes to make a comparison. He says the cost of running one assay twice a day is about 20% of the cost of running that same assay 1,000 times a day. So you're talking about a 50-fold improvement in unit costs as you scale up at the extreme. So scale really matters. And so what happened was Dr. Martin looked at this business in food testing in France in the early days and made the conclusion that this is really a business that should be served by a hub and spoke network where you have a few large hub labs that have very high volume throughput for the most common assays, and then spoke labs that are very close to the customer and have very quick turnaround times for those tests where speed is important. And that network didn't exist. And so he decided to build it. And he built it by acquisition, and that was the playbook that he started with, and he has then applied that playbook over and over and over again in entering new markets. And what he does is he targets niche markets that are limited in size, where there aren't that many assets to buy. So once he buys them, there's really not much left for a competitor to roll up. And the goal of Eurofins is typically to be the number one scale competitor in any market it enters within 5 years. And preferably, it will be 2 to 5 times the size of the second largest competitor. And so this playbook has been what he's been running ever since he started the business in 1987. And It makes a lot of sense. And it's interesting that other large testing companies like SGS, like Intertek, like Bureau Veritas, they do acquire, but they've never done it with this intent, the same level of focus that Gilles Martin has brought to the task. And as a result, they're very different businesses and they have very different growth rates.
What is wonderful about it is that, if I can summarize, they have powerful economies of scale on testing, that I can offer you a better price if you give me 1,000 tests instead of 10. And in addition, there's a lot of source of customer captivity associated with that, because customers are going to be reluctant to start sampling other labs. So they're going to be reluctant to move away. So you combine these economies of scale with this source of customer captivity, and all of a sudden you have enormous pricing power and you're deterring entry, because even if you match the scale, the entrant won't be able to attract the customers of Eurofins away. And it seems to me, if I understand you correctly, Chase, that in addition, Mr. Martin has been incredibly disciplined in terms of acquisitions, very focused, building kind of like an onion. You start with food purity, a very French thing, I would say, and then you start building around it to increase the scope of the testing that you can do for several businesses. Do I understand that correctly?
Yes. And he started even more specifically with wine, which you couldn't think of anything more French.
This is just, they're incorrigible, these French. It's an amazing business. Can you give us a little of these magnitudes of the company? What are the numbers that we're talking about?
Yeah. So
in terms of revenue, stock price.
It's a little over 5 billion euro revenue, 1.5 billion euro EBITDA, and you can think of it as about $1 billion in EBIT or EBITA. And the market cap is about 22 billion, enterprise value of 24 billion euro. So not a cheap company by any measure. And that's something that we should get into a little bit. Some of those earnings are COVID related, but the company is growing at a relatively quick pace, and the COVID testing is persisting longer than I think we originally anticipated. So I don't expect the earnings to go significantly backwards. One of the things that I think is interesting about the business is that when Gilles Martin would acquire, it's a very fragmented business. So there are tens of thousands of labs out there. A lot of them are mom and pops. They're scientists who run this very specific niche. And a lot of them he would acquire at break even. They'd be break even operations, and Eurofins could take them to 20% EBITDA margins in the span of a year. However, generally speaking, the acquisitions are depressive to margins. In addition, Eurofins does a lot of greenfield lab startups, and they take 3 years to break even. So they are also depressive to margins. And in addition, in order to differentiate themselves from their competitors, they've invested an enormous amount into digitization and into proprietary laboratory information management system. Again, depressive to current earnings. And so Eurofins has undertaken a lot of painful steps that public competitors generally were unwilling to undertake, because the impact it would have on their near-term margins was significant and deleterious. And so I think that's really important. Gilles Martin still owns a third of the company. And as a result, he runs it very much like a family business. I mean, it's very professionally run, but in terms of his incentives, he runs it like his baby. He's very proud of his track record of long-term EPS growth. And so I just don't think that we could have gotten a public company managed by a hired gun to behave in the same way. And I think that's been a big advantage for Eurofins as it has executed this land grab over these niche testing areas over the last 30 years, because it really was there for anyone else to see and to interrupt. If SGS had, for instance, one of their large public competitors had more capital, it could have easily interrupted that process of dominating these small niches, but it just didn't have the motivation to watch its margins decline as it invested heavily for future earnings power. Just an important aspect of why Eurofins has succeeded. And I think that was also part of the opportunity for us, because typically if you punched Eurofins up on a screen, you would see returns on invested capital that looked like they were in the high single digits. And that was the case even when Gilles Martin was telling us that he was earning 20% returns on his incremental capital investments. So that reinvestment, it really masked the true earnings power of the business for a very long time. I think the other thing that's important is that it required leverage to grow as quickly as Eurofins grew. And so the end market that they are operating in is really important. The important aspect of it is that these end markets are non-cyclical and they grow faster than GDP, all of them. You're looking at end markets that historically have grown organically at about 7%. There's a fantastic organic tailwind there. And the business grew organically in 2009 during the financial crisis. It grew organically in 2020 during the pandemic. So you can put some debt on the balance sheet without undue risk. And he's generally run the company with a significant amount of leverage. It's not very leveraged today because their earnings have really skyrocketed thanks to the pandemic. But you can safely put 2 times, 3 times, even 4 times debt to EBITDA on this balance sheet, given the diversification and the non-cyclicality of the end markets. And that has supercharged their growth as well.
This is an important point in a way, which is many of these roll-up stories, in a way, as you were saying just a moment ago, Chase, require the leverage. And that makes it even more important to understand the incentives of management to really monitor those acquisitions, select them properly, really for the analysts to zero in on the quality of the process by which acquisitions are being made. Is absolutely key. In a way, leverage increases the risk and it puts more pressure on process and on the analysis that you need to do in order to assess that it's not going to blow up in your face effectively.
Very important. And I think in these 2 cases, the size of the acquisitions is also important.
Well, of course.
It's scary if managers are scaling up their acquisitions to keep their growth going. And that's something we're always vigilant about. You have to be on the lookout for it, even if it's a manager that has been extremely successful in the past. You have to make sure that there's no mission creep there or growth imperative that's causing them to change their criteria.
So we're introducing a new segment to our conversation, which is one I love. And that is, what are you guys reading these days? And what book or books would you recommend to our listeners? So maybe, Will, we can start with you.
So lately, I have a lot of books open. Some of them I finished recently. So I've got, Noise by Kahneman and Siboni and Sunstein. I've got some science books, The Rise and Fall of the Dinosaurs by Bruzate, which is fascinating. I don't know if you know, but the market share of Triceratops in the Hells Creek Formation was 40%. And T-Rex.
The market share of Triceratops? There you have it. Our listeners are incredibly well informed about market shares. Yes.
And then Breakthrough by Walter Isaacson about CRISPR. And then 1,000 Brains, which is Jeff Hawkins' new theory about the neocortex. The one that I would recommend, which I think flies a little bit under the radar in terms of investing books, not one of the classics, is Common Stocks and Common Sense by Ed Wachenheim, who's a great investor and just writes so cogently through his thought process on a number of investment case studies that he's compiled over his career. One that I thought was extremely well written and very informative.
Well, can I follow up on Noise? We talked about just a few moments ago about bias, and bias is obviously a sort of a systematic departure from proper process. And Noise is sort of this unsystematic set of mistakes. So when you went through that book or even understood the basic thesis, did you find that some of those concepts applied to how you did your own process and how you guys think about managing money? What does noise mean for investors versus bias, which is much clearer?
Well, noise is just, essentially, I think it's just mistakes or variability in process. And so one of the things that the book recommends or documents is noise audits. That's the thing that I want to bring to the firm very shortly, is to do a noise audit and to just present a case study to our analysts and say, there's this company and we can identify or de-identify it and say it has these certain financial attributes. It's this earnings multiple and this earnings trajectory, has this much debt. How would you value it? And I wonder what the disparity is going to be. We'll have to report back on that and see.
So in the book, they mentioned a noise audit at an investment firm, and that was one that I did. So I've done that, and I also do it with my students every year. So I always think numbers will be smaller than they are. So we'll see if you guys are as surprised as I was when I ran it. So the numbers you see in the book, and it's toward the beginning of the book, that was actually a noise audit that I did.
That's so funny. It's great.
So Chase, books for you, past, present, what you like, what you recommend to our listeners?
Not all of them would be investment books. What I've been reading recently, one that I loved is How Not to Be Wrong by Jordan Ellenberg. It's a treatise on the power of mathematical thinking. And that sounds dry, but it's not. It's really entertaining. And he's a fantastic writer. And he himself was a math prodigy, so well qualified to write about it. My wife has me reading a book called Switch right now. She's in the nonprofit world and she's trying to make some changes to the way doctors practice medicine. And Switch is about how to change things when change is hard. It's all about the psychology of change, and I find that fascinating. One thing I would recommend people do is read the annual letters of the very best and smartest capital allocators out there. And I'm talking about businessmen. So in that vein, I am launching into Invent and Wander right now on the recommendation of a friend who's also an investor. That's just the collective writings of Jeff Bezos. The collective writings of Warren Buffett, published by Lawrence Cunningham, had a huge effect on me. And I think even if something hasn't been analogized or put into a compendium, there are many people out there worth reading, and Mark Leonard is among them. Will, I don't know if Mark's letters have been collected yet, but
they're available online. Lawrence Cunningham is on the board there, so maybe he's working on it.
Yeah. So those have been the ones I've been reading lately. I'll throw out some really unusual ones, and these go back 25 years, but they actually were important to me back in the days when I was an options trader before I got into value investing. And those were Getting the Best of It by David Sklansky. It's a book on the theory of poker. There's a lot in there about separating process and outcome. Blackjack for Blood by a professional gambler who wrote under the pseudonym Bryce Carlson, who has a lot in the book about gambler's ruin and money management. The Mathematics of Money Management by Ralph Vince was an important book for me back in the day. I would say that those aren't necessarily super relevant to a very focused value investor, but they are very helpful with the thinking mathematically about how to manage a portfolio.
Well, that's awesome. Will Pan and Chase Sheridan of the Hyperion Fund, thank you guys so much for coming to the Value Investing with Legends podcast.
Thanks for having us.
Thanks so much for having us. It's good to see you, Mike. Good to see you, Tano.
And to all of you, thank you for tuning in, and we will see you in our next episode. Thank you again.
Thank you for listening to this episode of the Value Investing with Legends podcast. To subscribe to the show or learn more about the Heilbronn Center for Graham and Dodd Investing at Columbia Business School, please visit grahamanddodd.com. Thank you.